There could be 50,000 cases detected per day by the 19th. And again, as we predicted, we're seeing rising hospital admissions, and we must reconcile ourselves, sadly, to more deaths from COVID.
So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives. It no longer paralyzes our nation.
And to those who say we should delay again, the alternative to that is to open up in winter, when the virus will have an advantage, or not at all this year.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition on Tuesday, the 6th of July. I'm Francine Lacqua here in London, and here's what's coming up on today's program. OPEC talks break down the conflict between Saudi Arabia and the UAE, blocks the cartel from agreeing an oil supply increase. WTI crude hits its highest in 2014. The English experiment. Boris Johnson says England will end social distancing, capacity curbs, and work-from-home guidance on July 19th. And the ECB enters its final stretch of its biggest strategy review in 2 decades, with climate change and the labour market on the agenda. Well, Bloomberg learns talks may culminate in an announcement this week. So welcome to Bloomberg Surveillance Early Edition. Quite a lot going on. OPEC Plus has plunged into crisis. The Allianz called off talks yesterday after the bitter fight between Saudi Arabia and the UAE blocked a supply increase, sending crude surging towards $80 a barrel. Now, what happens next will determine whether the breakdown could escalate into an issue as destructive as last year's price war. Well, joining us now to discuss this further is Will Kennedy, our executive editor for energy and commodities. Will, thank you so much for joining us today. You joined us yesterday, the day before that, and the day before that. Things are getting worse.
They are. We seem to have reached quite an impasse here, to the extent that they decided to give up on July's meeting, and at the moment it's not clear whether they'll actually have any substantive talks for another month or so under the current structure. They're due to meet in early August. So I think the word to use is stalemate, but something perhaps has got to give. The current situation is sending oil prices higher. We've just seen in the last few minutes that in the US, oil prices are now at the highest since 2014. And we had an intervention from the White House last night, who really called on the capitals involved to compromise and said that the Biden administration was engaging with concerned parties.
But will a higher oil price, to the extent where actually it scuppers a recovery, is in no one's interest? So is there still a chance that the two sides, and is it really OPEC, on one side, except for the UAE on the other?
It seems like that. I think there are 3 main players here: Saudi Arabia and UAE, obviously, but also Russia. Not having an increase will really hurt Russia, and Russia will be pushing hard to broker some kind of compromise, because Russia went into this meeting very keen to increase output. They're not quite like the Middle East states, where they can just ramp up oil and output immediately. They need to take time. They need to be able to plan, and this kind of situation makes it impossible for Russia to do that. So they will be pushing a resolution. But among the two protagonists, Saudi Arabia and UAE, the positions are really very dug in, and the key to the next few days will be watching to see how they react. Will the UAE do something to push the situation forward, perhaps by increasing production a little bit? Those are the kind of things we need to be watching.
Well, what kind of, I know we've been speaking and, hitting the phone, speaking to traders. What's the oil price range that we could see? Could it go to 100, or would that be something that actually won't happen for at least a couple of weeks?
If we look inside the guts of the oil market at the spreads between different contracts, we're seeing that oil in the short term and through the third quarter of this year is really in demand right now. People are putting a premium on oil you can deliver in the short term, and that shows that the market's screaming for oil. And I think short-term prices could go quickly higher from here, but there's a difference perhaps between the short-term and the slightly more medium-term 2022, when there's a risk of more oversupply, especially if this UAE oil comes into the market as Abu Dhabi wants. So there are different risks on different time frames, but in the short term, yes, prices are going higher, and I think a lot of people think they could go higher still.
Well, thanks so much. Will Kennedy there, Executive Editor for Energy and Commodities. Now, we're also getting a pre-market for Didi. Yesterday, remember, we talked about Didi quite a lot. We'll get a lot more on the story in 10 minutes with our Sofia Horta y Costa in Hong Kong. Now, the ramifications of China actually cracking down on Didi, remember it IPO'd in New York a short while ago, has, of course, implications for U.S. investors. So a Didi pre-market, you can see down 25% out of the news in the last 72 hours. Coming up, ECB officials gather for its biggest strategy review in almost 2 decades. A key issue at stake is agreeing to a new formulation of the inflation target. So we'll get more on that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. England plans to lift all COVID restrictions, including social distancing and venue capacity limits, from July the 19th. Face masks will be voluntary and the government will no longer instruct people to work from home. Prime Minister Boris Johnson says cases will continue to rise, but people must learn to live with the virus and exercise judgment to protect themselves.
We must be honest with ourselves that if we can't reopen our society in the next few weeks, when we will be helped by the arrival of summer and by the school holidays, then we must ask ourselves, when will we be able to return to normal?
Now, the leaders of Germany and France are urging China to allow more flights from Europe as one way to strengthen political and economic ties. The three-way video summit also discussed cooperation in Africa and global vaccine supply. An official said the leaders agreed there was a window of opportunity to revive the Iran nuclear deal. And Japan will reportedly hold the opening ceremony of the Tokyo Olympics without any fans, giving up on earlier plans for spectators at the July the 23rd event. The Asahi newspaper says IOC members, sponsors and other officials will indeed attend, but efforts are being made to downsize numbers. Venues with a capacity of 10,000 people or more will also be banned from having spectators or games after 9 p.m. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, the ECB's top policymakers are gathering this week for its biggest strategy review in almost 2 decades. A key focus is agreeing to a new formulation of the ECB's inflation target. Now, the central bank's role in fighting climate change, as well as how to address an ever-evolving labor market, will also be high on the agenda. Well, joining us now is Peter Shafrick, global macro strategist at RBC Capital Markets. Peter, as always, thank you so much for joining us. What exactly are you expecting from the ECB? So we think that there will be some, maybe asymmetric look at inflation. What would be the right way of looking at it?
Well, first of all, as you said, there's a whole laundry list of things that they're looking at, ranging from plain old monetary policy things such as what is inflation to things that haven't been previously included, such as you just mentioned, green elements and what have you. If we zoom in on sort of the things that are probably the most impactful for the markets, I would probably say there's one, what actually is the definition of inflation. And there's a lot of debate about whether or not that should potentially include owner-occupied housing. So that's basically a measure of how much does it cost and how does the prices develop for owning and maintaining your own home. And that hasn't been previously included. And that's probably going to lift inflation a little bit, not massively, but a little bit, but it's probably quite far out. And then the second element is really sort of what is their remit about what they're targeting. As you know, currently it's just under 2%, and that's likely going to change.
So, Peter, what are the market implications for all of those changes?
Well, the biggest change for markets that we think is likely going to happen is that when you look at that inflation remit, I mean, first of all, they're probably going to drop the just under 2%, but that's small beans compared to other things. And then the other big question is they currently have what they call a symmetrical target around that 2% handle, but they never really defined exactly what that symmetrical is supposed to be. And there's two rivaling definitions. One is that you should be just as aggressive if inflation is above the target as you are below the target, so you're symmetrical in your response. And the other one is symmetrical over time. So basically, if you are below the target or have been below the target for quite some time, you can be and shall be above the target for some time to iron sort of the differences out over time. So that's obviously much, much closer to an average inflation target. If they move to something like this, which I think is quite possible, what that means is if you run some modeling, it will take an awful amount of time until we iron out sort of the sub 2% inflation period that we just came through.
Peter, does it make sense, actually, the way you look at what the Fed is doing and what the US is doing and what Europe is doing and also different dynamics in this region? Would it make sense to look at it through that lens?
Well, I think that it does when you really sort of take 3-4 steps back and think about what do they want to achieve in the first place. And one of the biggest economic and societal elements that have been causing problems over the last decade, at the very least, is that you have a very strong imbalance, particularly on the wage earner side, with low income brackets not having benefited at all from the recent upswings and recoveries that we had after the last two crises. And I think one of the elements that shall be pursued is that you allow a longer period of time in a rebounding economy to allow wages to rise, to iron out some of these imbalances as well. And the central bank's contribution would be to allow that to happen without reacting immediately. Now, if that's the case, and particularly, again, if you go back to the modeling of Europe, I mean, it will take much, much longer in Europe before you get anywhere close to achieving an average inflation target. And if that's the case, in my mind, that also means that the short end of the European curve will be anchored probably until the middle of this decade.
Peter, let's also talk about OPEC Plus. I mean, there is a real danger that actually the price of oil goes up. How dangerous is that for the global recovery?
I mean, there's always with these natural resources, always a double-edged sword, of course, because on the one hand you have the producers who are going to benefit from it, and on the other hand you have the importers who have to pay the price for it, of course. So, I mean, for the US, it's probably less of a problem than it is for the European continent, because apart from sort of one or two, there's hardly any meaningful producer of oil and energy, oil and gas. And particularly for the continent of Europe, that's clearly a drawback. So it's probably adding to the price increases that we already had. And one of the things that sort of could be seen as a danger for also in the light of what we just discussed is if the current transitory elements, particularly of higher energy prices, turn out to be much, much longer in their transition period than we previously assumed, and therefore the high energy prices cause a higher overshoot of inflation, and that's typically a negative for generally for the economy. It's the wrong type of inflation, if you want. It's not the inflation that's been created through higher wages. It's an external effect.
Peter, I also want to ask about China because there are a number of stories that we're following. First of all, Didi and what that means for U.S. investors, but also future listings of Chinese tech companies in the U.S. The other underarching, of course, is defaults and what happens with some of the defaults. Will they be managed correctly by policymakers? And then, of course, we have questions on some of the PMIs that we saw that have been a little bit weaker than expected in China. Just a simple question. Are you worried about the direction in which China's taking, or do you think that they can still be a source, I guess, of growth for the world?
I mean, there's multiple questions, of course. So let's for a second leave sort of the listing questions and the geopolitical element potentially aside. And if you just look at the current dynamics, there is, of course, a risk that the upward dynamic that we've seen coming out of China and probably the entire Southeast Asian region is lessening a bit. And if that's the case, particularly again, sort of if we bring it back to Europe, that's potentially a negative for us over here in Europe, because as we have discussed many times before, we're very open economies. and we generally benefit when the rest of us, when the rest of the world is doing well, indeed. So that could be a drawback. But for the time being, I think these negative cyclical elements, they are relatively contained. So let's leave it there. As far as the geopolitical element is concerned, and the potential of making it much harder, for instance, for Chinese companies to list in the US or somewhere else, and all these type of things. I mean, in my mind, those are questions that go to the heart of how we currently do things, how we operate on a global scale, how companies sort their finances on the one hand, but also operate their production chains. And these are things that potentially have quite large ramifications, but the time period is much, much longer. I would think like 5 to 10 years. So it's nothing that sort of affects us in the immediate time frame.
All right, Peter, thanks so much. Peter Shafrick, also with really the best background in the business. Do we pay you royalty to have the Bloomberg terminal? Well done, Peter. Peter Shafrick, global macro strategist at RBC Capital Markets. Now, coming up, as China continues its crackdown on big tech, ride-hailing firm Didi remains firmly in the crosshairs. So the company is now banned from Chinese app platforms. Does this actually hail the beginning of a new normal for Chinese tech firms? We'll discuss that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's take a look at some of the events we're watching today. At 10 a.m. London time, we get Eurozone retail sales recorded in May. The data is expected to show an increase of more than 4% over the previous month. Now, Germany's ZEW survey will be out at the same time. It will report the latest outlook for the German economy. And as you've heard, ECB policymakers will hold a special meeting in a bid to complete the strategy review. And finally, the annual Sun Valley Conference is set to return after being cancelled during the pandemic. Mark Zuckerberg, Warren Buffett, Jeff Bezos are expected as what's known as a summer camp for muggles. Now, China's ride-hailing giant Didi is the latest tech firm to be brought to heel by Beijing. Despite listing in a blockbuster U.S. IPO last week, yesterday saw the app banned from Chinese platforms. Now, the move underscores the Chinese government's commitment to controlling the 21st century's most valuable resource, its data. Joining us now, Sofia Orta-Costa. She is Bloomberg's China reporter in Hong Kong. Sofia, thank you so much for joining us. So why is Didi actually being targeted by Beijing, and what do we know about the Chinese motivations?
Good morning, Francine. So Didi down as much as 28% in U.S. pre-market trading. Obviously, U.S. markets were closed yesterday, so you see the big reaction to this news. So Didi, as you say, it's a ride-hailing company, but most importantly, it's used by 500 million. It has 500 million annual regular users, and that is just the majority of them being in China. That is just a huge amount of data, extremely sensitive data that the Chinese government does not want to hand over to U.S. investors, and that is what we're hearing is the main motivation for this kind of regulatory clampdown on Didi specifically. But obviously, looking back and more broadly at Chinese tech in general, a lot of these mega cap Chinese firms that are looking to list in New York, or at least selling shares outside mainland China, a lot of them have access to troves and troves of data. That was the problem, of course, also with Ant Group, the financial, the Fintech giant that did not list in November because Beijing, told that company that it had concerns over the influence that it had over the financial system, Francine.
So, Sophia, who exactly are the biggest losers here?
U.S. investors. The fact that China decided to announce this 2 days after the IPO, or announce that it was reviewing the company, and then only 3 days later that it was banning the app from app stores. It is quite telling that they did this after the IPO. had already started trading. U.S. investors, seeing obviously significant losses. We'll see that today. But also Chinese companies that are looking to raise funds. Remember, these companies are significant. They make a lot of losses. They need the cash to grow. They need the cash to expand their businesses, looking for overseas expansion as well. Where are they going to get that funding? That pipeline is going to look really, really difficult now for NYSE and NASDAQ listings. Francine.
So, Sophia, what exactly does it mean that Chinese firms don't want to list in the U.S. anymore until they get like a green light from, Beijing, or is it U.S. investors that don't want to buy into it until they get some kind of clarity on what's going on?
Yeah. Exactly. I think it's a twofold dynamic here. Chinese companies will always want to list in the U.S. We saw, a huge amount of activity this year, even though, as you remember, Francine, in March, the SEC, the securities regulator in the U.S., came out with a very stringent rules that began during the Trump administration and are getting tougher under Biden. That makes it more difficult for Chinese companies to sell their shares to U.S. investors, and also for existing Chinese companies already trading in the U.S. To be a part of, a portfolios in the U.S. So the environment is already difficult, but companies will always look to the U.S. for listing. That's where the biggest capital market is, right?
Thank you so much. We'll have plenty more on Didi throughout the day. Sophia Orta-Acosta. Coming up, we'll also talk about COVID. OPEC talks break down. The conflict between Saudi Arabia and the UAE blocks the cartel from agreeing an oil supply increase. WTI crude hits its highest since 2014. The English experiment. Boris Johnson says England will end social distancing, capacity curbs, and work from home guidance on July 19th. And the ECB enters its final stretch of its biggest strategy review in 2 decades, with climate change and the labor market on the agenda. Well, Bloomberg learns talks may culminate in an announcement this week. Good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on Tuesday, the 6th of July. Some of us are also a little bit distracted by the football, the Euro football game happening later this evening, Spain versus Italy, 8 p.m. UK time. On to other matters, though. Boris Johnson has announced plans to end social distancing in England from July the 19th. Face masks will be made voluntary, and the government will no longer instruct people to work from home despite a surge in infections.
We're seeing cases rise fairly rapidly. There could be 50,000 cases detected per day by the 19th. And again, as we predicted, we're seeing rising hospital admissions, and we must reconcile ourselves, sadly, to more deaths from COVID. We have to balance the risks. The risks of the disease, which the vaccines have reduced but very far from eliminated, and the risks of continuing with legally enforced restrictions that inevitably take their toll on people's lives and livelihoods, on people's health and mental health. And we must be honest with ourselves that if we can't reopen our society in the next few weeks, when we will be helped by the arrival of summer and by the school holidays, then we must ask ourselves, when will we be able to return to normal? We will change the basic tools that we have used to control human behavior. We'll move away from legal restrictions and allow people to make their own informed decisions about how to manage the virus.
Well, joining us now is Sam Fazeli, who leads our pharma coverage for Bloomberg Intelligence. Sam has been really a beacon of wisdom. And Sam, you help us understand exactly some of the right decisions, some of the wrong decisions, and how we should think about it. So, look, after the announcement of Boris Johnson yesterday, a lot of people, are relieved that finally we're getting back to some normality. Others question, why are we not wearing masks if in other countries you still wear masks, despite the vaccination uptake? So how do you see this?
Yeah, good morning, Francine. So I'm halfway between the agree and disagree camp. I agree that at some point we just have to bite the bullet and get on with this, because there could be yet another variant around the corner, and whatever. It's just been a very unpredictable pandemic that we've been dealing with. So, but on the other hand, I don't understand where the return to normality and freedoms, how that's impacted by still asking people to wear a mask on crowded places, in crowded places. Of course, you can't have that and go to a nightclub. You can't imagine people will wear a mask. So maybe this is a pragmatic decision, but I don't get that either. Why would we need to revive all those things for an economic revival and not wait another 2 months for those little aspects until full vaccinations of adults have hit the 90% range?
Sam, what's the right way of actually looking at this, though? So do you look at, what do we know about the vaccinations? Do we finally know whether you can still transmit if you're vaccinated or whether it actually stops the transmission?
Oh, no. You can still. It's all about reductions in probabilities. You can still transmit the virus if you're fully vaccinated. In fact, there's more and more stories like that. And so you're not going to get rid of transmission. It's just reducing the risk of it. So, and the vaccination rates are going up quite nicely in the UK. I predict that by 19th we'll be close to 70% fully vaccinated and close to 90% people with adults with one dose. But of course, there's the 12 to 18-year-olds that we have to consider. So why don't we put them in the equation?
Yeah, and I think I was looking at figures. There were like 375,000 kids that were isolating because of COVID-related, because they've been exposed, basically, of students, right, of kids, I think between the age and 5 and 18. So do we need to get everyone vaccinated, including small children, to make sure that we get rid of this?
Yeah, I think your phrase, to get rid of this, I think we have to forget about that. We're not going to get rid of it. To reduce the risks further and further, I think certainly we need to think about the adolescent group. The younger children is a bit tougher to think about, but if we can get the adolescents at least, where we have data that the vaccines work and they're relatively safe, then we should get those done too. And I'm surprised the government isn't talking about that.
Sam, I think we saw in Israel a mandate to, not having to wear masks, and then they had to go back to masks. Is mask wearing effective? I know there were also a couple of questions on plexiglass and whether that's efficient. Like, how much are we wiser about what works and doesn't work to contain it, like 3-4 months ago?
Yeah, no, I don't think, Francine, much has changed about the efficacy of the effectiveness of masks, especially if two people are wearing it. Remember, the idea is that a good mask, and I stress, a good mask probably gives you a 20% increase. I'm plucking a number out of thin air. I can't remember exactly what it was, but it was in those ranges, 10 to 20%, 30% risk of you acquiring a virus. And then if you're infected, it significantly reduces your risk to other people. So when you combine the two with really good masks, you can get up to about the 90% level. Now, those studies were done with other versions of the virus. Now, with this variant, maybe that's come down a bit. But still, if you layer that on top of what vaccination gives you, that's pretty high protection if we had just kept the masks. And I don't understand why it's gone.
Sam, so one of the other things that that we struggle to understand is exactly what's happening with travel. So, for example, I'm trying to get to the G20 in Venice this weekend, which means, isolating almost on both ends. It means, about 5-6 tests to then test and release back in the UK. But then from July 19th, I'd be able to walk in the street, going to a museum without a mask.
Yeah, but traveling, it looks like we're going in the direction of at least allowing the vaccinated folks, fully vaccinated folks, to travel without the need to quarantine on either end. Even Germany has just dropped its requirement for British people and Indian and Portuguese from having to quarantine if they're fully vaccinated. So if the UK does the same, then that aspect of our lives gets a bit easier. How long that lasts, Francine, I don't know. It all depends on how countries get worried about infection rates, etc. But currently it seems to be that within a couple of weeks, I wish your G20 was earlier, we'll be able to do this without isolating either end.
Sam, thanks so much. Sam Fazali there from Bloomberg Intelligence, of course, on COVID-19 and some of the variants. Now, coming up, Fintech and the City, the former chief executive of Barclays, joins this program to talk about his latest venture and how the digital banking landscape is shaping up in the UK. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Buyout firm Bridgepoint Group has confirmed it's going ahead with a London IPO. It has filed its intention to float document after announcing last week it aims to list at least a quarter of its shares to raise about £300 million. The UK private equity company invests in middle market firms across Europe. It has stakes in Burger King franchises and in Itsu, the Asia-inspired food company. Now, Ocado has signed an agreement with Auchan to develop the retailer's El Campo online business in Spain. The companies will initially build a customer fulfillment center to serve the Madrid region starting in 2024. Separately, Ocado has reported EBITDA for the first half ahead of the average analyst estimate. Credit Suisse says it is planning to introduce a work model that gives its employees in Switzerland maximum flexibility. Approximately 13,000 staff will be able to decide with their teams and managers how much of their time they want to spend outside and inside of the office. The bank says policy for the rest of the 49,000 global employees will be determined by local guidelines. And Xiaomi is planning its first green bond as part of a broader package of dollar-denominated debt, adding to a surge of green securities from Chinese issuers. Bloomberg understands a smartphone maker has hired banks to arrange fixed-income investor calls today for the proposed bond offering. The company has seen a surge in phone shipments ahead of other big global producers. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, London's digital banking scene is growing. 10x Future Technologies, founded by former Barclays chief executive Antony Jenkins, is a fintech firm helping established banks make the transition to digital. And in the last month, it has raised almost $200 million in its Series C funding round. Now, it's being backed by investment heavyweights BlackRock, JP Morgan, and Canada Pension Plan Investments. Well, I'm delighted to be joined by Antony Jenkins. He's founder of 10x Future Technologies. Antony, thank you so much. I thought we caught up actually earlier than we had, so it's a wonderful update to see how you've lived through the pandemic. And actually, when you look at where banks are today, after many years at Barclays and in big banks, what have you learned about the difference between big bank and fintech?
Yeah, I mean, one of the things about COVID is it's massively accelerated digital adoption in all areas of our lives. I mean, look how we're conducting this interview. And I think what that's done is increase the imperative for big banks to go digital. And that doesn't just mean making an app. What it means is making a great user experience, which really adds value to their customers' lives. Simplicity, speed, economy in terms of pricing, those things are really important. And I think what's happened in the fintech sector over the last 5 years is fintechs have demonstrated that those user experiences can be built. And the imperative now for the larger banks is to do the same thing.
So what are your plans for the company? You've raised some $187 million, I think, in June. What are your expansion plans? Are there new markets or new technologies that you want to get into?
Yeah, I mean, we're incredibly excited at 10x. It's been almost 5 years. We're celebrating our 5th birthday this year. I can't believe it's been 5 years. But up to this point, we've been focused on really honing the technology and making sure the technology delivers that 10x promise. We're working with 4 clients currently. 3 of them are live at the moment. And by the end of the year, 2 of them will be live at scale. That's very exciting. But our big objective now is to scale the business, add 10, 20, 30, 40 clients globally. We're targeting particularly North America and Europe, but also we have a footprint in Australia, so Asia is very interesting to us. So we are really at that point now of massively scaling the business. That's what we raised the Series C for, and we're incredibly happy to have the high-quality investors that we've got in the business.
Antony, there's a Fintech Wise, which is going public by direct listing tomorrow. Is it something that you would, look for 10x?
Yeah, I certainly wouldn't rule out an IPO. As somebody who's been the CEO of a publicly traded company, I know the pros and cons of that very well. But I think if it was right for the company at some point, we would certainly contemplate it seriously. I don't think that's in the next 1 to 2 years, but it could certainly be in the next 3, 5, 7 years' time.
And what do you make of the proposed rewrite of the UK listing rules? Do you think it will attract more fintech companies to London?
Yeah, I think it's hard to say. I mean, our culture around publicly traded companies and the balance between the rights of shareholders, founders, and management is different to the US experience. So I think the proposals are good proposals, but I think it's uncertain as to whether it's going to really shift that balance of listing towards the UK. The UK has many attractions as a listing venue. As you mentioned, a huge fintech is about to IPO on the market. So it's a good place for us to be in the UK, but I think it's always appropriate to consider whether there are modifications that could be made that might help us become even more attractive.
Antony, overall, how are you approaching working from home or, return to the office? So do you want people back in the office? Do you think it's a good recruitment tool if you're more flexible compared to some of the big banks?
Yeah, I mean, we are a global company, so we have people on the ground in Australia, we have people working for us in India, obviously the UK, and so we've been dealing with this at the global level, not just the national level here in the UK. Our position has always been to put the safety of our colleagues first, and so we went to remote working sooner than the government recommended in this country. I think we've proved that we could be productive and effective working remotely, but we've also learned that when you need to be creative and collaborate, there's nothing like being there in person. Our office is open for a modest number of folks to be in, and in fact, I've got my leadership team in a COVID-safe way this afternoon to go through some strategic matters for us. So, I think what we will do at 10X is gradually bring folks back in waves, depending on their work requirements. But I would expect us to go into a hybrid working model. I think we can make that work in 10X, and I think it's also important to provide flexibility to our colleagues.
Antony, we also talked about, you clearly said that you want to expand and actually, get bigger at this point. How much bigger do you think 10X will be in the next 12 months?
Yeah, I'd see this journey as being the next sort of 12 to 36 months. I would see us adding somewhere between 5 and 15 clients over that time period. And once we get to there, we'll be a sizable SaaS-based technology company. And back to your earlier point about IPOs and so on, I think an attractive candidate for the market. So, there's a lot of work to do, but we're incredibly well positioned in a category that is literally expanding at the speed of light as banks grapple with all of the digital challenges that we talked about at the start of the interview.
And if the IPO is I think you said 1 or 2 years away, or that you'd certainly be thinking about it, is it given that it's in London, or what's your thinking on that? What are the parameters that you'd be looking at?
Yeah, to be clear, we would contemplate an IPO not before that time period. And London is a very attractive market. It's our home market. I think it is friendly for companies like ours. There's a great ecosystem of support around us here. It's a highly respected market internationally, as you can tell by our private market investors, both international firms. So, I think London would be right at the top of my list if and when we contemplate an IPO.
Antony, thank you so much. As always, Antony Jenkins, their founder of 10X Future Technologies. Now, coming up, WTI crude rises to the highest level in more than 6 years after OPEC Plus failed to agree on a production increase. So that story is up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a lot of the market focus will, of course, be on what the ECB has said, will say. A lot of the focus is on oil. Our Will Kennedy was bringing us up to date on the spat that's just escalating. There is also a question whether the UAE could actually leave OPEC Plus. I don't know whether that will become a reality. And then our other stories, of course, Didi slumping after Chinese regulator orders stores to remove that from the app, down some 25%. So let's get straight to crisis mode for OPEC. Let's talk markets with Bloomberg's Eddie van der Veld. Eddie, if the Saudis hold firm and there's an oil price spike, could that actually force central bankers to turn more hawkish sooner? Is this now a reality compared to yesterday was more speculation?
Yeah, I was really interested to listen to Will earlier, because this is exactly the problem for central bankers, is that oil prices are feeding through into inflation and forcing their hand perhaps on raising rates sooner than they would like to. I mean, central bankers would like to sit tight a little bit, I think, with rates where they are, and see, employment levels rise further before they start pinching off the recovery. But I think this is a difficult situation for them, because typically an oil price spike is something that is seen as transitory. But if you see oil prices continually drifting higher, and it feeds through into supply chains, and it feeds through into shipping costs, then it no longer is transitory. And that is the point at which the central bankers have to act. And I think this is difficult, and that's why I think we're seeing this reverberate across markets.
What does that mean for dollar, for example? Are the most expensive commodities playing a role in weighing on the dollar?
Yeah, I think just today when I look at it, so we had the Aussie and the Kiwi up, both on idiosyncratic factors there. But at the same time, I think what's happening here is that oil is rising, metals are rising. That's supporting commodity currencies. And that's just helping to add a little bit of weight to the dollar this morning. Now, the dollar, I think is stabilized a little bit, not as bad as it was in Asia in Asian hours. So things have settled down a little bit. But I think if this spat at OPEC blows up, I think the next few days could be very interesting in markets indeed.
Eddie, how much are you looking at the ECB? So we're expecting a review. We could have the findings as soon as this week. Are you expecting a lot of change, or what kind of impact could it have on the markets?
Yeah, the ECB is an interesting one. The ECB traditionally has lagged in terms of, changing policy. It was certainly behind the curve in the previous tightening cycle and pretty much got left behind as a result of the euro crisis and so on. But I think the ECB this time, particularly European banks, have struggled to get on the front foot because their rates have just been so low. The ECB would very much like to get on the front foot, but I don't think that they're in a position to do so. The recovery is not as strong as it is in Europe. Now we're starting to see PMIs coming through in Europe that are really spectacular. Every month we're seeing readings of 60 or thereabouts. If that continues and if inflation picks up, I think the ECB would like to start raising rates, but I don't think they're anywhere near it yet.
All right, Eddie, thank you so much. Eddie van der Walt there from our MLive team. We'll have plenty more, of course, on the markets today. A big OPEC day because we need to look at exactly what's happening with the price of oil. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kailey Leinz actually off for the week, so we'll be joined by Danny Berger here in London with me. The markets, so we'll look at treasuries. We'll look at what exactly is happening in oil. The other big story, of course, that we're watching today. I don't know if we have the market board. If we do, it'd be great to get it up. So we also look at Didi, a slumping in pre-market after the Chinese regulators ordered the stores to remove the app. Now, the other thing I'm looking at, of course, is oil. We'll have full coverage of OPEC Plus with our Will Kennedy. That will be in just a couple of minutes. Oil jumping to the highest in more than 6 years after this bitter fight between Saudi Arabia and the United Arab Emirates plunged once again OPEC Plus into a crisis, blocking a supply increase. We'll have a full roundup of our top news stories ahead. This is Bloomberg.
We must be honest with ourselves that if we can't reopen our society in the next few weeks, then we must ask ourselves, when will we be able to return to normal?
So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives. It no longer paralyzes our nation.
We're no longer looking over a cliff, but instead we're transitioning from recovery to expansion.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, July the 6th. Our top stories today. OPEC Plus fight rocks the oil market, while crude rises to a 6-year high after infighting prevents a deal to increase productions. China strikes back while Beijing's crackdown on big tech puts dozens of U.S. IPOs at risk. And new worries for British business: COVID restrictions are being relaxed, but some companies are concerned about being held liable if infections rise in the workplace. Well, good morning, everyone. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off this week. Now, Matt, there's quite a lot going on in the markets because of OPEC. They're fighting. It's getting worse, and actually it's driving the price of oil higher.
Yeah, I find it absolutely fascinating, though. There's so much involved in this. The UAE apparently feels it can pump a lot more oil than it's allowed to right now. Plus, they want to prepare for an oil-free future. And in order to do that, they've invested a lot of money and they want to reap the benefits. So they kind of want to reset the relationship. That's something the Saudis don't want to allow, because then maybe everybody is going to want to reset the relationship, and it could be chaos, dogs and cats living together. You know how that goes. Let's take a look at what's going on in the Asian markets here. You can see that we have kind of a mixed trade, at least, but it looks a little bit better when you look down into Southeast Asia. One huge exception is Vietnam. The Vietnam index is falling now more than 3 standard deviations away from its average 30-day Z-score. I know that from looking at the GMM. You can see here down 4%. We're hearing reports there that it's profit-taking, which I know as a former stocks reporter, that's what you say when you don't really know why it's falling.
Yeah. That's exactly what you say.
Nonetheless, I mean, maybe, it has to be partially profit-taking, but it could be fear as well. People are selling. Yeah. It's not wrong. You're right. It's not wrong. Rice futures, I just thought was interesting. Tom Keene years ago turns me on to the importance of rice as a staple food for a massive portion of the world. It's incredibly important. And I think sometimes the West loses sight of that importance. Right now, it's getting a lot cheaper, which is good news for people who need to buy rice. And then the Aussie dollar, I put that in for the RBA. Danny's really excited about the RBA, more so than I am, but we could see a shift in, Danny, isn't this right? We could see a shift in their monthly asset purchases, which are, millions of dollars worth of asset purchases every month.
Okay, but it matters, Matt, because it means that they're dialing back some of the QE, right? I don't care if it's millions, if it's hundreds, it's a change, right? And we care about shifts here. Matt, I also wanted to flag news coming out of there in Germany, the ZEW, if you want. German index. I know I'm getting pretty European these days. Coming in weaker than expected in 63. The estimate was 75. This is just the latest data we've gotten out of Germany this morning that's looking weaker. We also had industrial numbers, which disappointed as well. You can see the DAX falling 0.4% over here. A lot of that is car makers. Actually, car sales looked pretty weak in that industrial data as well. Elsewhere, the only place you're really going to find green in Europe is in Eastern Europe. Elsewhere, I mean, we have unchanged in the FTSE 100. France is weaker. Spain is weaker. So not exactly a bright picture, but not a horrible one either. So that means the main stock 600 benchmark index, rather, flirting with moving lower today. But I want to get into what some of is moving that, because the news coming out of the UK making a difference here, with Boris Johnson saying, hey, we're going to relax some of the social distancing, if not all of it, giving you an option whether to wear a mask or not. Right. And so that means that we see a stronger pound ever so slightly.
I'm really surprised. I mean, the Germany factory orders, I don't know whether it points to like a two-pronged, German economy, or what the concern is out there, because it's basically supply chains, right? We're back to kind of square one in trade, and we're not exactly sure when we'll get back on track.
Right, exactly. The fact that this is a confidence indicator is really essential here, because you can have factory orders, which was the data we had earlier giving us the numbers, but how people actually feel is really crucial to how they're going to stockpile, the money they're going to spend. That's really important, isn't it?
Yeah, it certainly is. What else are we watching? So I know we're looking at pound because we're reopening. We're reopening on July 19th, and apparently we don't have to wear a mask
for now.
Anymore.
Don't have to wear a mask for now. It's up to you. If you're in a crowded tube and you want to wear one, you can. Travel and leisure also doing well because of possible flight. We're also looking at crude, NYMEX crude at its highest since 2014. And really, I put a lot of stuff on the board here that's probably driven by that. Higher yields. Is inflation going to be a concern? Is that what oil is driving today? Is it waking up the bond market? So we're seeing small cap do a little bit better, cyclical rotation perhaps. NASDAQ futures lower. This could just be, again, a rotation, or it could be the effects of China cracking down on U.S. listed Chinese companies. Francine, if you're an investor here, you probably are concerned about the headlines over the weekend.
Yeah, I mean, if you're an investor, you probably don't want to play into some of these companies. If you're a Chinese U.S. company, I mean, you're a Chinese company, a tech company, you probably don't want to list in the U.S. until you understand the rules coming out of Beijing. Now, this is what else we're looking at today, Danny. ECB policymakers holding a special meeting in a bid to complete its biggest strategy review in almost 2 decades. We're expecting an update on the New York City Democratic primary as absentee ballots come in. And finally, the annual Sun Valley Conference is set to return after being canceled during the pandemic. Mark Zuckerberg, Warren Buffett, Jeff Bezos are expected at what's known as a summer camp for moguls. Do you remember when we used to play that game, Matt, who you'd invite for dinner for your perfect dinner party? I don't know whether Sun Valley's one of them, but maybe it makes the Matt Miller list of invitees.
I don't think they'd be on my list. Nope.
Okay, we'll talk about Matt's list shortly. OPEC Plus, though, in crisis amid worsening infighting. The alliance called off talks yesterday as the bitter argument between Saudi Arabia and the UAE blocked a supply increase. Brent crude rose to its highest level since November 2014. So let's get more from our Bloomberg executive editor for energy and commodities, Will Kennedy. Will, is there any turning back, or actually now we're not going to have a deal and the price of oil just shoots up?
Well, I mean, the oil prices reacted sharply to yesterday's news, as you say, Francine. In New York, we're back at the highest since 2014, and that's going to be an issue for the White House because people are starting their summer driving season and paying more than well over $3 a gallon for their gasoline. And that's why I think we saw some quite strong words from the White House last night looking for a compromise. Where that compromise comes from, though, is difficult to see. Both sides are dug in. Russia isn't happy. But unless UAE and Saudi Arabia get talking again, it's hard to see how this gets resolved anytime soon. In the meantime, there's no scheduled meeting until August. The market's not going to get the barrels it wanted in August. It's going to have to wait till September. And that's why we're seeing prices shoot higher this morning.
If I could pay $3, if I could get a gallon of gasoline for $3, I would back up the truck because I'm paying twice that here. I just want to make that clear. And I do drive a truck. One thing I'm looking at, Will, is the forward curve. And of course, we're looking at prices that get lower and lower and lower the further ahead, the further out you go. I wonder what this means in terms of investors thinking maybe OPEC members will be non-compliant in the future. Maybe OPEC members will disagree more and more as we go forward. If they break away and decide to sell as much oil as they want, what does this curve look like?
Yeah, no, I think the curve is telling an important story, as you say, Matt. In the short term, it's screaming for oil. So you're seeing prices at the front of that curve move sharply higher, saying, you know, in the next few months, you know, we're pricing to draw down inventories really, really hard because the market's not supplying what we need. But next year looks a bit more uncertain. As you say, for the reasons you say, you know, the UAE seems determined to produce more oil come what may, and, you know, we don't know how that will happen through a deal or through a rupture, but it will probably happen. Iranian oil is likely to come back into the market if we can get a deal at those talks in Vienna. And the other thing putting pressure on the back of the curve is if you're a shale producer right now and you see this curve moving upwards, you could lock in for next year, and I think there's some selling pressure there. So it's a short-term bullish, but the longer-term price outlook, as you say, Matt, is a lot more uncertain.
Well, thank you very much. That's Bloomberg Executive Editor for Energy and Commodities, Will Kennedy. Now, Chinese companies hoping to list in the U.S. may now find it harder to pitch their shares to prospective investors. This, of course, as China cracks down on ride-hailing giant Didi and other technology firms that have recently listed in New York. Let's get more on this with Sofia Horta y Costa, Bloomberg's chief China market correspondent in Hong Kong. Sophia, do we have any idea of to what extent Didi was communicating these risks with shareholders? Was this present, or was this a surprise when we learned of the crackdown over the weekend?
Well, as you can see with the share reaction today, the stock down as much as 28% in pre-market trading. It was definitely a surprise for investors who bought into the IPO. And let's not forget, Didi is not a small company. Its IPO was $4.4 billion US. This is the second biggest IPO of a Chinese company in New York since Alibaba in 2014. And what we're hearing from talking to people here is that the Chinese regulators were talking to Didi at least 3 months before its IPO, saying, delay the IPO. We have concerns over the data, the security of your data. So Didi did know that there was a review going on. It went ahead because it wasn't actually in breach of any rules.
So, Sophia, when do we have clarity, right, from Beijing what exactly they want? If you're a U.S. investor, you don't want to get into a Chinese company. If you're a Chinese company, you probably don't want to list at the moment.
Yeah, exactly. New York is a very attractive place for Chinese companies to list. There is a very deep pool of capital there. Valuations are much higher. And if you just look at the performance of U.S. stock markets, they do so much better than China or Hong Kong. But for, the concern for Beijing is that it doesn't have rules in place. It needs more time. There isn't a regulatory framework. This new rule, cybersecurity rules, the body only really came into effect a year ago. So this is all very new for China. It doesn't really know what to do with the vast amounts of data that these private companies control. And if these companies are then selling shares to investors, they're in the hands of foreign international investors. That is another problem for Beijing. It just needs more time to figure out how it can control, these things that are very important for national security in China.
Right. Well, if it's going to take more time, we'll see how much further the prices will fall then as they figure it out. Sophia, thank you so much. That's Bloomberg's Sophia Orta y Costa in Hong Kong. And with that in mind, let's get a check on some of where these Chinese U.S.-listed companies are trading. Didi, as we've been discussing, falling 21%. Just want to flag it IPO'd at $14, so very much so below its IPO price. Now, another company that's getting caught up in the probe as well is Full Truck Alliance. We don't have as many details as what they're looking at here, stopping new registrations, much like Didi for this truck-hailing app. That one is down 15%. This one IPO'd at $19. So yet again, another IPO in the U.S. from a Chinese company below its debut price. This one IPO'd about 2 weeks ago. Finally, Alibaba, a bit weaker so far this morning. Of course, it's not one of the companies that China has specifically been targeting with this probe. In the past, they've been targeted for antitrust concerns, but all of this China-U.S. listed tech space at the moment in this morning's session pre-market is certainly under pressure, with investors asking, does this mean that we're about to have a restart, Francine, of the concerns of China cracking down? Is this the next leg that could, again, affect a company like Alibaba?
Yeah, it could. So all eyes, of course, on some of these big tech companies. Coming up, we'll talk China, we'll talk ECB, we'll talk oil prices with Trevor Greetham, Royal London head of multi-asset. And then a little bit later on, we'll also talk about inflation targeting by Madame Lagarde with Ludovic Subran, he's Allianz chief economist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Francine, Lacqua, and Danny Berger. Kailey Leinz is off today. Now, we're very much focused on the price of oil, which continues to rise. That's good for oil producers, and they're heavy on the FTSE. Right now, the FTSE is fairly cheap because earnings expectations keep rising as well. If we look at the forward PE ratio, I want to bring in Trevor Greetham to talk about this from Royal London Asset Management. He is the head of multi-asset there. And Trevor, a lot of talk lately about UK stocks and their valuations and whether they're a buy right now. I want to get your take.
Well, our tactical models are actually pretty neutral in the UK, but there's got to be a big catch-up trade coming. So you quite rightly say the UK market's very heavy in the resource sectors, so the big oil majors, but also mining. It's also big in financials that tend to do better when interest rates rise. And it's got big sectors which have been lockdown victims in the UK, consumer-facing sectors in particular. So we think the UK is going to be a really great market over the next year or two. We're not quite sure now is the moment, but I certainly wouldn't want to be short the UK versus other markets. My hunch is the outperformance of the UK will probably come when technology sectors have another derating session. So it might be a bear phase outperformer rather than a bull phase outperformer, if that makes sense.
Trevor, what does this all do for dollar? So how much do commodities and also the price of oil, weigh on dollar further down the line?
The dollar's been a real puzzle to us actually this last year, because on the one hand, very often when you see a global recovery, particularly a synchronized global recovery with strong commodity prices, the dollar is weak, and you can rationalize that by portfolio flows out of the US, investing in other areas, for example, strong emerging market economies and therefore strong emerging market currencies. But this seems like a very different environment because you've got very big desynchronization around the world because of COVID hitting in different ways in different places. And you've got, a much more stimulus in the US in terms of fiscal policy, making US rates look like they're going to go up much more rapidly than other countries, for example, in Europe, will be raising interest rates. And that argues for a strong dollar. So we waver between the two at the moment. We think at the moment, this is one of those really unusual times where you can see a strong dollar and strong commodities.
Trevor, we can tease that out just a little bit beyond the dollar. I was talking to Ron Smith of BCS this morning, who said that should we continue to see some issues in OPEC, we could get $100, $110 a barrel oil. In that sort of scenario, how does that change your asset allocation strategy? How does that change the inputs to your model should we see oil at triple digits?
It's a really good question. I mean, we have a framework we call the investment clock, and that looks at what's happening to growth and inflation cycles. And at the moment, we've been in the overheat stage, strong growth, rising inflation pressure for 10 consecutive months. And if the oil price keeps going higher, that keeps inflation rising. It's going to keep us in that overheat phase. And in terms of asset allocation, that says we should be overweight commodities, which we are in our multi-asset funds, and underweight government bonds. And I think the risk there is if you see this summer of strongly rising oil prices, the pressure will be upwards and upwards on the US 10-year Treasury yield. And I think that could be a problem for the highly rated technology sector. So that kind of outperformance of the UK, which tends to do better when inflation's rising, it's all kind of related really to this theme. And I would expect commodity prices to keep doing well because of the reopening going on in Northern Hemisphere developed economies, particularly as we work through COVID. But there's lots of uncertainty still. It's going to be very bumpy. We don't know, for example, if the UK's gamble on reopening is going to pay off, whether actually we'll all be retrenching again into the autumn. So plenty of volatility along the way.
Exactly what I wanted to ask about, Trevor. Are you hedged for another step backward? I mean, we're already hearing people complain about the UK reopening, and across Europe, there are concerns that the Delta variant could force lockdowns again.
Yeah, I mean, I liken it to the UK as a nation is failing to finish its course of antibiotics. We haven't yet got all of the adults double vaccinated. We haven't certainly started on children. We've got this virus that's doubling in terms of caseload every 9 days. Already 750,000 people in the UK have got it, according to the ONS. And we'll be up to 1 million, 2 million, maybe even 3 million people over the next few months. And I think there's risk around sterling here that at some point, either there'll have to be a move back into restrictions. And Boris Johnson was very keen, actually, yesterday to backpedal on the irreversibility of these measures, or people may just take it into their own hands to socially distance again. So I think there's a big gamble there. Obviously, there's the other side of the coin as well, that if we work through this big wave of infections, we build up immunity, the NHS, the National Health Service copes, then the UK economy will be probably that much stronger at the end of it. So lots of two-way risk in sterling, but if anything, we're actually trimming exposure to a currency that we've been overweight all year.
Trevor, thank you so much. Trevor Greetham, there, head of multi-asset at Royal London Asset Management. We'll have plenty more on the markets shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off today. Now let's get straight to the Bloomberg. First word news, and the European Central Bank is entering the final stretch of its biggest strategy review in almost 2 decades. Officials are trying to hammer out key differences over monetary policy. A major issue is agreeing to a new formulation of the ECB's inflation target. In Hong Kong, a U.S. lawyer has been jailed for a little more than 4 months over a fight with a plainclothes police officer. Samuel Bickett's scuffle took place at the height of a pro-democracy protest in 2019. He's a former compliance director at Bank of America Merrill Lynch. Now, coming up next, we'll talk a lot more about the economy. We'll talk about oil. We'll talk about inflation. We'll talk about the ECB review with Ludovic Subran, Allianz chief economist. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off this week. Now, a lot of the focus, Matt, is on, of course, it's on the inflation review, it's on the ECB and all of that. It's on Didi, but really it's all about OPEC and the fact that they're not finding a deal. Actually, it's escalating and getting worse.
Yeah, absolutely. I think, Didi was a fun story. And of course, there's a much bigger story on China. Bloomberg has been doing some incredible reporting and analysis into that. But for now, oil is front and center. What's going to happen in terms of compliance for OPEC? Is the UAE going to make a move here? Is everything going to get smoothed out? And where are prices going to go?
Yeah, the million-dollar question. Danny, how's it all playing out in the markets?
Well, I kind of feel like I don't even need to do a market check now because that's exactly what's happening. Everywhere else is really struggling for direction. It's only oil that has the clear move higher today. Well, we know WTI highest since 2014, Brent highest since 2018, up 0.3%, hovering just around $77 a barrel. During the Asian trading session, it looked like yields would move higher, that we had all this concern about inflation. They are barely moving now, not even a basis point. We have the dollar slightly higher as well, but that's only 8 basis points. And we do have a little bit of a weaker session when it comes to U.S. futures. I, for one, will be interested to see the first time in 7 days that the U.S. market has not hit an all-time high. Even if it's only a little bit down, that at least is something. Well, let's get a look on some of the pre-market movers. A big one is going to be anything energy related. This is the energy ETF, the iShares one of the biggest ones, up 1% so far pre-market. We've been talking about Didi a lot. That is still down about 22%. Of course, scrutiny on China, a lot of these U.S. Chinese listed IPOs. And with that in mind, the last one I've included here is another one. It actually was up some 14% when the market first opened, but I guess investors got their head around it, realized it was a Chinese company listed in the U.S. It's called Pop Culture Group, and I think I found my new favorite stock because this is a hip-hop promoter. I was looking through its prospectus trying to figure out what the ties were between the U.S. and China, and it said that their service, we aim to promote hip-hop culture, its values of love, peace, unity, respect, and to promote a cultural exchange with respect to hip-hop between the United States and China. So, Matt, even though there's tension between U.S. listings of Chinese companies, this company is a hip-hop company, and they say they will bridge the divide.
Well, I guess that's a lofty goal, and good luck to them as well. I just think the Didi spat is so fascinating. Maybe they could have given investors an inkling that that was going on before they listed. Maybe investors are going to be unhappy that they didn't. But really, it's all about oil. And that's the chart that I've brought you here today for our listeners on London DAB Digital. I welcome you as I do that every time at this day, and I'll walk you through what we're looking at. This is the correlation between the price of Brent crude, still the global benchmark, and the S&P 500. And the correlation has been positive for so long. In fact, only once in the past 6 years has it turned negative, in 2017. Now we're negative again here, and this could portend big moves for the future. So if the price of oil continues to rise, is that a problem for stocks because it's a problem for the economy, Francine? That's a good question for our next guest.
It is. It's almost it is the perfect question, not almost. It's the perfect question, and we look at the risk of divorce between, of course, the S&P 500 and oil. So, no better person to answer this question than Ludovic Subran. He's chief economist at Allianz. I know Ludovic is also somewhere exotic, I think, in France. So, congratulations for all of us that can't travel, Ludovic, from living the good life. Ludovic, when you look at the price of oil, actually, at what point? I don't know if there's a target price that it starts being uncomfortable for central banks.
For central banks, no price should be uncomfortable, right? Because they should see through the headline inflation. But for stocks, for example, the threshold is between $70 and $80 per barrel, because this is where you start to have, the positive effect of the investment cycle, especially in the energy sector, starts to be offset by the negative effect for oil importers and for those companies for which oil can represent up to a point of margin when it comes to, having to use these commodities that are slightly higher. So we are right at the tipping point, and this will be interesting to see how the OPEC and OPEC Plus actually reach a deal that will calm down the market and make all of us have a better summer.
Well, we do want to have a good summer here, and I guess we're going to be using a lot of oil, Ludovic, regardless of the price. What does this mean to the reopening? What does this mean to growth if we start to see $80, $90, $100 barrels of oil?
It means that we will have headline inflation, so we will overshoot by, 10%. Let's say $10 per barrel extra is equivalent to 0.2 additional, so not 0.2 additional on the inflation year on year. So this could actually lift a little bit the expectations on the market, but it could also, and this is where it is interesting, in the real economy, this would add up to an already very heated industrial commodity cycle. So the question is really for those importers on the import bill, and that could be costly for some countries, especially in Europe, like Italy. But it is also for companies, some companies are reporting incredibly high import prices overall, right? And so if the oil prices actually takes another 5%, 7%, you start to really hit the profits and to certainly, this be a major disincentive to more capacities and more investment cycles. So this is important to keep the oil price, slightly below 75, even below 70, to make sure the second half is actually a good one for all of these reopened economies.
With some of the oil price movements that we've seen, at least here in the short term, there had been this question to whether it would be sort of the jolt that woke up the bond market. We're not really seeing that. We're still seeing 10-year nominal yields at 142.38. Ludovic, what is the bond market telling you right now? The fact that regardless of the data we're getting throughout the U.S. economy, it's stuck in a pretty tight range.
It's interesting because in the first, major surge of the U.S. 10-year Treasury yield, most of it, I would say 75% of it, was explained by the commodity market. So this time around, the fact that there is this volatility on the oil price and that it's not triggering any type of steepness of the U.S. yield curve means something that people see through it. So they don't react to it, and they've priced in most of the supply and demand mismatch and do not really take this bluff, this supply speculation bluff for granted. And so I think it's quite good news. It means the market is less, I would say, erratic or less unhinged as it was, 3 months ago when it comes to inflation being a permanent shift for our economies.
Ludovic, I also need to ask you about the ECB. What exactly is the right way for the ECB at this point to look at inflation?
The ECB has given us some insights about the idea to change the inflation calculation, which is a very French thing to say. When you miss your target, you start changing the rules. So they want to include a little bit more real estate prices into the definition. They certainly want to symmetrize the target. So I think for the ECB, the problem is the heterogeneity here again. We may have a third quarter where Germany will actually be above 2% inflation. So you get, for the ECB and especially for President Lagarde, the issue is to have a tight governing council as long as possible. Because this is really what will make it through the March 2022 deadline, which is the end of PEP, and certainly till the fall of 2022, when the political ghosts are actually going to come out again when it comes to the divergence between the North and the South. So it's all about seeing through, keeping the community tight, and making sure, we don't average the inflation target like the US do, but we see through headline turmoil, and we really look at core inflation, which today is still very much in check.
Well, are there places, Ludovic, where you see any structural supply constraints? I mean, Javier Blas was talking about oil maybe as one because the majors are being pushed not to explore and produce as much for ESG concerns, and also being drained of their cash for dividends and share buybacks. Are there other pockets of structural supply constraints out there?
I think building material is worrying to us, including actually in the construction sector. Both industrial inputs and labor are under some form of shortages, especially in the US, but slightly also in Europe. I'm concerned personally about the container price of trade, which has been multiplied by 10. And by the fact that those containers are full of electronic prices and not of industrial commodities. So I'm still very much in the camp of those people thinking, it's about a year of normalization, but I still see construction, material and inputs, and of course, semiconductors, electronics, and chips still being for us on the shortage side. And this is why, what is interesting, right, is that we enter a speculation phase, a speculation whereby a lot of companies, instead of ordering one container, order two, because they don't know what will be the price of the container. And this is the worst that can happen. This should remind us of the 2007 food crisis, where every Asian household was buying 2 kilos of rice instead of 1 kilo, and the price of rice increased by 400% over 3 months, right? So I'm concerned about this, deja vu on the industrial commodities, especially in building materials, electronics. This is why I see the tensions as we speak.
Ludovic, thank you so much. Ludovic, who are you supporting at football today? Spain or Italy?
Anybody
the
but
real
England.
Important question.
I'm sorry, for the final, I don't want to see England. Yeah, that's it. So, I support Italy because they're doing a much better job at tapping into European next generation EU. So I'm supporting Italy for economic reasons.
There you go. There's always a link
Forza
between
Italia,
football and the
Francine.
economy.
Forza Italia.
There you go. Forza Italia. Ludovic Subran, their chief economist at Allianz, joining us, as always, in a good mood. Now, coming up, ending the lockdown, easing restrictions in England could mean new concerns for businesses. More on that next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an exclusive conversation with the Binance U.S. Chief Executive. He's Brian Brooks. This is Bloomberg.
We must be honest with ourselves that if we can't reopen our society in the next few weeks, when we will be helped by the arrival of summer and by the school holidays, then we must ask ourselves, when will we be able to return to normal?
The UK Prime Minister Boris Johnson announcing plans to end social distancing in England on July 19th. Now, face masks will be made voluntary, and the government will no longer instruct people to work from home despite a surge in infections. Let's get straight to our Sam Fazeli, Bloomberg Intelligence Senior Pharmaceuticals Analyst. Sam, there are a lot of questions on actually what works for one person because the risk aversion doesn't work for the next. But a simple and hard question to you. Would you go to the Wembley Stadium today to see Italy against Spain? Is it safe to be outside in crowded places?
Yeah, but Francine, I'm assuming that that's a rhetorical question because that's exactly what you're planning to do. Look, it's an outdoor space. I've not been scared of outdoor spaces for quite a while. I'm a double masker anyway, so as soon as Delta turned up, I thought, well, I need a little bit more protection there. So I think the worry I have, I've been on an airplane just last week. The worry I have is that you've got a situation where the arena or the plane itself isn't necessarily the most dangerous thing. It's the monster queue in that tiny little hallway that they line you up to get onto the plane, or the place wherever you go to get into Wembley. It's a long time since I've been to Wembley. So that's where the risk for me is. If you can try and minimize that crowding, then I think you'll be relatively safe.
It's not agoraphobia, Francine. It's a knocklophobia. That's the fear of crowds. But it can be overcome, probably with pharmaceuticals or a vaccine. I mean, Sam, if we're vaccinated, why should we be afraid of stuff? Isn't this fear getting to be a little bit too much? Should we be pushing the other narrative? If you're vaccinated, you're probably going to be safe?
Hey, as I said to you, I got on a plane, but I'll send you the photograph of the area where they were holding people before we were getting on the plane. And honestly, I was very happy that I was wearing my mask with that little additional protection that I get versus an infection, including I don't want to catch COVID-19. I don't know what it will do to me with my vaccine in terms of long COVID. I have no idea.
What is the case fatality rate right now among vaccinated populations?
Yeah, I mean, if you look at the latest data that we had from the Public Health England, the numbers are, if you multiply the protection against the infection plus the reduction in hospitalizations, it gets you to a very low number. But it's not about death, Matt. I didn't say I'm worried about death. We know that the risk of death, the risk of hospitalization is much lower with double vaccinations. What I don't know is what happens if I catch the infection in terms of its sequelae, such as long COVID, and how long do I suffer, don't I suffer? Why expose myself when all I have to do is put a mask on my face? What's the problem?
Sam, thank you so
I
much.
thought the mask protect others from you and not you from others. But that would be good if the mask protects you from others.
I mean, yeah, I think both of you have to have masks, Matt. Otherwise, you have less protection. We'll do diagrams. This is what we do. We look at mask wearing and diagrams. Sam Fazeli there from Bloomberg Intelligence joining us. Now, coming up later on, Bloomberg Surveillance, Amos Adalja. He is Johns Hopkins Center for Health Security Senior Scholar. That's at 6:30 a.m. in New York, 11:30 a.m. in London. We'll ask Dr. Adalja mask wearing. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Francine Lacqua and Matt Miller. Kailey Leinz is off today. Now, Blackstone President and COO John Gray says it's still a pretty good time for real estate. Gray provides his views on a range of topics, including the booming property market, on the first episode of Bloomberg Wealth with David Rubenstein.
Well, if you talk about for-sale single-family housing, there's probably more risk in the sense that you're building something and you're selling it and it's a function of the market. If you're talking about rental housing, think about an apartment complex, that tends to be less risky because it's less cyclical. People don't give up their apartments when there's some volatility, but nothing like, say, office buildings or hotels. So I would say residential rental real estate safer, less volatile. And then commercial real estate involves office buildings, warehouses, which has been the biggest theme for us over the last 10 years, hotels, shopping centers, senior living facilities, and all of them have different risk returns depending on geography.
Another way of looking at real estate are things that are already existing and things to be built. So is it riskier and higher reward to build something, or are you more in the category of trying to buy things that already exist?
We generally are in the business of trying to buy existing real estate at a discount. So we bought the Cosmopolitan Hotel and Casino in Las Vegas, and we bought it for less than half of what it had been built for because it was built during the financial crisis. So that to me is ideal. Occasionally we'll build things, but in general, we like to try to get into real estate at a lower basis when it's already producing income. The problem with development is it's a bit like saying I'm going to IPO 3 years from now. When you show up to lease up your building, we could be in a different economic environment, and therefore you may not have tenants, you may not have revenue. So we've generally biased towards existing real estate.
Well, you can catch the full interview with John Gray on Bloomberg Wealth with David Rubenstein. The show debuts tonight, 9 p.m. in New York, and July the 7th at 7 p.m. in Hong Kong and London. Now, the one and only Tom Keene, fresh back from barbecuing his way through July the 4th weekend. Happy July 4th. I don't know whether, is it a thing that you can still say it on July the 6th? Of course, he's anchor of
You can
Bloomberg
always
Surveillance.
say it. In the great United States of America, every day is July 4th.
Happy birthday, America.
Just a quick note, Francine. John Gray, I'm a huge John Gray fan. This is going to be an interesting interview with David Rubenstein. John Gray is truly one of the young philanthropists of New York City. This is a guy who put his money where his action is. It'll be great to see that. Speaking of money, Matt Miller's Bentayga, his Bentley, I should say, his Bentley Bentayga V8, 44 seconds. It's like, 4.4 seconds to get from 0 to 300 miles an hour. Let's go to the chart of what's going to set young Miller back in a gallon of gas. This is not in liters. I'm sorry, Matt. I can't do the conversion. It's too early on a 4-week Tuesday. $4 a gallon. $4 a gallon is a level we've known. Down we go with the great gasoline disinflation, outright lower prices over the years. And Francine, we've really spiked up. This is set in $2021, $3.18 a gallon.
Yeah, wait, hold on. So is Tom Keene and Matt Miller driving up the prices of like expensive cars? Is that like the bottom line of your?
Are we driving together? Are we going on a road trip?
A road trip. I can see that. I'm going to go south of 59th Street. What I would say, Francine, is we're finally seeing a bit of a slowdown in auto sales. They have been a boom part of this American boom economy.
Tom, I'm looking forward to your interview with Richard Haas and also Dr. Adalja. Matt Miller is saying, auto sales, especially luxury.
There are 3.7 liters in a gallon. I just want to point out that I pay like $2 something per liter. So I'm paying like $7, $8 a gallon here to fill up my truck. If I had the Bentley Bentayga, I would choose the W12. They make a W12 engine, which is really unique. Yes?
You live in central Berlin. Where are you driving to?
How are you driving
I drive a lot of places.
Berlin?
For Steve, I have a European-sized truck, and Steve has a big bed in the back, and I drive him around to all the national parks and the state parks around here. That's what I do after the show every day.
Which, Matt, is why you and Steve, for those who don't know, is his dog, are looking at OPEC. And Danny, you're also watching OPEC.
Yeah, obviously for what it means for Matt and Steve. Yeah, the disagreement, are they going to revive talks? It actually seems like it might be long-term bearish, because if they don't revive talks, who's to say that they're going to continue to have discipline? So, Matt, that's what I'm looking at with you and your precious dog, Steve, in mind.
I'm going to actually watch soccer. I'm going to sit down and watch an entire soccer match today, all 90 whatever minutes it is, because, they can just magically add a guesstimate at how many minutes they need to at the end of the game, and hopefully penalties as well, because I think that's probably the most exciting part. I will root for, I'm going to root for Spain. I'm sorry, Francine, because my wife is Spanish,
this is,
so
what I'm watching. I mean, I'll watch the game, but I'm also watching my family to see how much they love me, whether they're rooting for Spain or Italy. So that's what I'm watching. It's like, the barometer of how much love Francine gets in the Lacqua household. Also, I'm watching the ECB. So there's a strategy review. It's a pretty big deal. We could have some kind of news this week, but they're meant to enter the final stretch of the biggest strategy review today. Officials are looking to hammer out some key differences. Of course, it's the inflation one that's the big one, but really there's a laundry list of what they'll talk about, including climate change and some of the other things that they've put in their monetary policy. So we're watching that. More Bloomberg surveillance coming up next. With the team, they look at treasuries, they look at OPEC, and they look at football. This is Bloomberg.